We've got CPI tomorrow. Let's talk about what to expect and what we are expecting. Last month on the CPI print, we saw a massive move in bonds. And ever since then, over the last month, they really have not looked back. So we are thinking bonds kind of know what's going to be happening ahead of CPI. Gamma, you want to talk about what we are expecting?
Yes. So let's first illustrate what I have or emphasize what I have on the charts here. So I have a split chart on the bottom. You'll see a blue line. This is the year over year headline CPI, and on the top I have a yellow line, which is the so long bond futures, and the orange line is crude futures. What we need to pay attention to here is that tomorrow the estimates for CPI are 7.3% on a year over year basis. The last print in early November for the month of October was 7.7. So we're looking at a 40 basis point decline via the estimates on a year over year print here in the next reading tomorrow. Now, the key here is what the market has done in the past month since the prior print at 7.7. We see bonds, for example, right? Look at bonds on the yellow line here. They're well off. They're well off their lows, even convincing people that the lows are in bonds and not peaks are in rates and inflation. Crude has slowly been falling. Now, why is this? Right? Look at what happened last time. So the last CPI print was here on November 10th. And if we look at November 10th, crude was barely down, right? Crude's barely down, bonds are barely up, and we got this 7.7 print. Now we have this move where crude's gone lower. And if we look at a monthly chart, it'll look a lot better. We have crude down, bonds up, and we're only seeing a 40 basis point drop in inflation. Now, obviously, I'm not here to tell you that CPI is just crude oil. That's bullshit, right? We all know that there's a lot that goes to the CPI basket. But long story short, from inflation expectations, bonds are moving and bonds are giving the feeling as if there is going to be a print under estimates. And if we get that print under estimates, maybe it's only 10 basis points under estimates, right? If we get that print, shit's going to go bananas, literally,
Yeah. So
right?
how do you think that will affect equities and bonds if we do get a print under estimates?
I think that you're gonna. So this is a really, really good conversation in the scope of where the pivot of deflation actually takes place, right? Because obviously everyone is foaming out of their mouth for slower inflation, right? That's the thing. Everyone's like, "Oh, inflation down, market's going to go back to the glory days, yada yada yada, whatever," right? But obviously, the next major concern is if we have a peak in inflation. This is a big if at the moment. We don't know yet. The system still hasn't signaled that yet. The next thing will be, when does deflation occur? Because deflation is not going to be fun for equity. It will, however, give us the Aries opportunity to go basically balls to the wall long bonds. But until the trigger actually comes to fruition, we're in this limbo land, right? What's going to happen? And the big concern here, right, on the initial drop of inflation is going to be that inflation is under control, and they will likely, most likely, they'll bid equities. Most likely, because what's going to happen is everyone's going to get all hyped up. Because unfortunately, reality is that deflation is most likely the next occurring regime. Most likely, right? But emotionally, no one wants to believe that, right? Everyone wants to buy stocks that, again, you could look at anything like the Russell 2000, the NASDAQ's still down 30% year to date, while the Dow's only down 8 or whatever it is. So it's something in that ballpark,
Like
right?
it's looking very deflationary.
Right. And people in this environment get very hyped up in the idea that, look, NASDAQ's down 30% or whatever, right? Again, ballpark numbers. Dow's down 8. If I buy NASDAQ, it'll close the gap at some point, right? So the idea is, if inflation is peaked, well, this whole reason why the NASDAQ is down, peak inflation, right? Or excuse me, runaway inflation. Well, that issue will no longer exist because people don't actually understand the cycle of the market. They're going to see, okay, inflation is peaked. It's time to go long tech. Because remember, the media tells you a bunch of fucking bullshit, and they'll tell you that if rates going up is bad for tech and rates going down is good for tech. That's what they'll tell you. But no one seems to pay any attention to the best performing macro regime, which is inflation, where rates and growth simultaneously both go higher. In that environment, rates are going up, growth is going up, and tech is booming. And it's very hard to actually lose money except if you're in bonds. So the big question that we have to bring in our focus to here is that with slower inflation, with lower inflationary prints, are we pivoting to deflation right away? And most likely the answer is no. Most likely the answer is no. And the reason for that is because to break this inflation, you're going to need interest rates to hold a period of hold in a period of high rates for some time, which is why the Fed is expected to hold rates at the way that they are for some time. Remember, higher for longer, because they need to break this inflationary, call it a curse, strong enough so it doesn't come back, or hard enough so it doesn't come back. And if they act too weak or don't act too to the point, what's going to happen is you're going to get a 1980s event, which the Fed has already vocally expressed that they do not want to occur again. So they're aware of the situation. And this goes back to the whole understanding of growth rebounding, right? And paying attention to how what growth's going to do, because for us to get deflation, and again, you got two camps here. Like I said earlier, you have the stock guys that are looking for a peak in inflation, time to tech, go to the moon, right? And then you got the bond guys, peak in inflation, time to long bonds, right? Bonds and tech. That's what you got. You got the bond bulls, you got the tech bulls. The problem that you're going to run into here is if we get that peak in inflation here and we start to roll over and we start to get these lower and lower prints, slow and steady lower, obviously things are going to start looking better and better and better. But growth now starts rebounding. Growth has been in the shitter. What you end up having is no longer deflation. You actually have a setup for a risk-on regime. Unfortunately, I think that there is a bigger setup here. We are going to get deflation at some point, right? The Fed is going to cut rates at some point again. So deflation is coming at some point. But will you fuck all those deflationary guys out with a short-term risk-on regime? And I think that's a possibility here with interest rates coming lower. Interest rates coming lower will solidify that the growth is on the rebound. Obviously, we've seen GDP prints, right, bouncing. Everyone's like, oh my God, growth bouncing back. Oh, great. Okay. Now, inflation coming lower. Well, oh shit. Now we're setting ourselves up for a risk-on regime and expansion. But again, look at the biggest risk assets. NASDAQ, right? S&P. Oh, S&P is a bit closer, but even the NASDAQ, right? That's way off of Momo.
Right.
You're
so
way down
the market's really not pricing that in.
Right. The market's not really pricing that in, but what we can get is a technical regime, which is what I'm trying to say, right? That technical regime where we have this risk on, that short-term technical regime where we can grab in we could basically bull trap a bunch of bulls here on a tech wrap. If rates come in lower than expected, we'll drive that bid in tech within a bearish trend, mind you, right? So shit, it's still bearish. It's not real risk on. Just like how this hasn't been real risk off, non-directional. You see what I'm saying?
Right.
So we bid them up and then we rug pull them into deflation. And I think that with the prints coming down the way that they're doing, we're setting ourselves up for that type of situation. Unless we see CPI nosedive, I'm talking nosedive in the next 3 or 4 prints under 4. Okay, we know that's not going to happen. What you're setting yourself up for is an actual bounce back in growth. Because think of them like 2 slingshots, right? And this one's stuck, but growth isn't. You pull growth down far and long enough and you let it go, it's going to bounce back. But think of this as almost a fucked up slingshot. Just the rubber is not strong, right? So it limps back slow and steady, and the ball rolls while growth is bouncing. Well, now you have that, what I'm talking, technical risk on regime, and people are going to get caught in that. And I think, long story short, that growth rebound, just as fast as it came down and bounced back, it can bounce lower again as inflationary pressures remain. The idea is, okay, and I'm going to simplify this in a corporate or macro term, right? Inflation blows up You come off the lows. What are companies doing? We know companies are firing people, right? Bonuses are getting cut, all this stuff. So you're going to give a short-term boost to the bottom line, right? These are all short-term fixes. But if the demand is not there long enough, what ends up happening is the growth eventually falls apart again. Think of this like a band-aid, right? And once that growth falls apart again and you have inflation coming down consistently, then you're in the deflationary. And that is where we'll likely see the Aries signal next. I mean, listen, again, Aries will signal whatever it wants to signal, and we're going to follow it. But I just have this inner feeling that it's like this almost like a
Like you feel it in your balls.
I feel it in my balls that we're not that we're going to get some type of on bullshit that here, and it's not going to stick. That's what I'm feeling.
Yeah.
And the reason is, again, because let me explain this to you. Inflation printing 7.3 is not fucking bullish,
No, that's still
right?
horrible.
But in terms of beating estimates, the idea for the tech bulls, look, inflation is, we'll think about it like this, right? Inflation, instead of going one way, inflation was doing this the whole year. Oh, up, beating expectations, going higher. Now they see this. They see the inflation going the other way. So now it's, oh, every time we're going to be under estimates, we're going to go lower. Things will repair itself. The problem is the rate at which it takes to get back to a reasonable level, right? Because like I just said, the firing, the bonus cuts, all this fluff that they're doing, at the end of the day, if inflation only goes from 7 to 4.5, like you're still going to run into problems. Eventually, those zombie companies that are just marginally getting by, if firing their staff right now is helping them float along, think about what happens if rates only go down 2%. At some point, the shit hits the fan and you cannot avoid it. And that's really the issue that we're running into with inflation. And obviously, the Fed knows this. They know that they need to keep rates higher for longer to make sure they kill this. They want this to be the peak. They hope that this is the peak, but they don't know just yet that this is. And they are going to, again, remember, it's better to be late to the party and sure than to be early and unconfident in this scenario. And we'll do more on what the Fed is expected to do in the next video once the CPI numbers come out. But long story short, where I want to leave this off today is most likely if we do get a lower than expected inflation print under estimates, we're likely going to see some type of positive move. Now, I could be wrong, but it's what bonds, why the market hasn't fallen apart yet. Bonds are ripping, market's not falling apart, crude shit in the bed. And we're only 40 basis points above estimates from the last reading. It's just, you have this utter feeling that, man, maybe we're going to print under estimates this time, and maybe people are going to take the market for a spin higher, and we'll see. But that's what I am getting out of the market this week. So I'd like to close it off here. And if you have any questions, feel free to reach out to us on our website or in our Discord. And the link to our Discord can be found on our website at market-radar.com, or reach out to us on Twitter at the Market Radar. Thank you guys so much for listening, and check back in tomorrow for the next episode.